Good morning, everyone. Thank you for joining me for the monthly webinar. Today's presentation will cover a touch on economics and markets. So I just want to summarize some of the key themes that have been playing out in the market. After that, I will show you the performance of all the portfolios as well as the performance of the market. And I will show you where performance really came from. So which asset classes really drove the performance in the portfolios. And then the last thing I want to end off with is I want to discuss the details of the Regulation 28 update. So there has been a draft that has been circulated for comment, and I want to touch on some of the details there. So just to start off, I just want to again reiterate what our mission and vision are at SURF. And our mission is to restore confidence in the retirement fund industry. And we believe we can do that through innovative product and services. And we want to make it easy for our members to plan a comfortable retirement. And our vision is to enable life-changing and dignified retirement outcomes. And we want to build a more financially secure future for all South Africans. So starting off with economics and markets, the one key item that everybody is looking at is the rate at which we're vaccinating the world's population. This is by far the single most important item from an economics perspective. And the reason for that is really the sooner we can vaccinate the world's population, the sooner we can get back to some sort of normality. At the moment, I'm sure if you watch the news, you would have noticed various countries around the globe, this country is in lockdown, and another country has restrictions, another country opens up. So until we get the full world population vaccinated, or a massive percentage of the world's population vaccinated, we don't expect to see that normal course of business. And where we are at the moment is a lot of countries are vaccinating at a very fast pace. For example, Israel did a very good job. Others haven't even started. So overall, if you had to look at the current rate of vaccinations, it would take us almost 5 years to vaccinate the world's population. We do know that the vaccination rate will pick up. As the testing back in the day, we started off with being able to perform very few COVID tests at the beginning, and now most countries can perform, a massive volume of tests every day. So likewise, we do know that vaccination will pick up, but the sooner it picks up, the better. The reason for that is you would have also seen if you watch some of the news, both locally and internationally, we've seen new variants of COVID-19. And the longer it takes us to actually get people the jab in their arm, the vaccine, the more likely it is that we will continue to see new variants popping up. And this is a massive risk because you never know. Some of these variants might be more aggressive than others, and you may find that the current vaccines might not do as good of a job for preventing severe disease with COVID-19. So really, really important that we get the world's population vaccinated. Then in America, we would have touched on this at the beginning of the year, but very positive that Joe Biden won over Donald Trump in the US elections. And earlier this year, he was inaugurated as America's 46th president. So all very positive for emerging markets. We know that Joe Biden is a lot more friendly when it comes to international relations. We don't expect any crazy antics from him. He's also very much pro, climate change and all the good things. And in addition to him winning the US elections, the Democrats, he's a Democrat, Donald Trump is a Republican, so the Democrats have control of the House of Representatives. And earlier on this year, we had the Georgia runoff, where the Democrats also took control of the Senate. So that's why markets have been calling it a blue wave, meaning that he can also pass legislation a lot quicker because the Democrats now control both houses of Congress. So that's why the markets have been calling it a blue wave. Now, one of the biggest pieces of don't know if you can call it legislation, but one of the key items that Joe Biden is wanting to put forward is, of course, his rescue plan. And part of the rescue plan to deal with the COVID-19 pandemic has been a lot of fiscal stimulus. So fiscal stimulus is when countries make a certain amount of funds available, and they provide it either by way of grants. Some countries have been paying, a certain amount to every person in their population straight into their bank account. So different countries do it differently, but fiscal stimulus really is money that the government is pumping back into the economy in order to assist with some of the turmoil caused by COVID-19, things such as unemployment, businesses being closed, all of those issues that come with lockdowns. Now, this latest package that Joe Biden is putting forward is to the value of 1.9 trillion US dollars. So it is massive. And there was concern that once you pump such a huge amount of money back into the economy, that it would cause inflation. Because what it would simply mean is that every American would have more money in their pockets because now they've been given some stimulus from the government. They could potentially go out and spend it. And as people spend money in the economy, demand for certain goods and services increases, which can push up the price. And when prices go up, that's when inflation goes up. And the way that governments deal with inflation is they typically hike interest rates if inflation gets too high. So there was a concern that this 1.9 trillion package would result in inflation because it is a massive amount of money. But the Federal Reserve has come forward to say that they will keep interest rates low right through to 2023, which is very positive. Why is that very positive? Because if US interest rates are low and close to zero, it means that the US bond market is not as attractive as other emerging markets, such as ourselves, for example, where we have higher interest rates, we're able to provide higher real yields, and foreign investors would rather invest into South African bonds, get more of a return than in a country that has near zero interest rates. There are other knock-on effects on the interest rates that I'm not mentioning as well, but overall it is positive that the Fed has come forward to say that they will keep interest rates low right through to 2023. Now, if you look at this chart that I have on the right-hand side of these slides, you'll see that generally the support that has been provided by various countries across the globe has been massive. And what we're comparing it to is to the stimulus that was provided in 2008. Now, in 2008, that's when we experienced the global financial crisis. So it was a different crisis. It was more of a financial crisis, whereas what we're sitting with now is a healthcare crisis that's trickling into the economy and the market. So it is a different crisis, but nevertheless, back then, countries also had to come forward and provide some stimulus. And you can see that other than Spain and Russia, most other economies have provided a lot more stimulus now than they did back in 2008. And specifically America, if you add on the 1.9 trillion package, you can see that as a percentage of GDP, the current stimulus that has been pumped into the economy is almost 25% of their GDP, which is simply just a massive amount of money that has been pumped into the economy to help. China is an interesting one. China is the only G20 country that seemed to have managed to grow in 2020. They dealt with the pandemic relatively quickly, in very strict lockdown, out of lockdown, back to almost full mobility, all within the first couple of months of 2020. And they have benefited a lot from what has been going on around the globe. They have benefited from their exports. They have been, exporting all sorts of hardware to people around the globe that are busy setting up their home offices. So we're talking computers, laptops, printers, scanners, all of that type of hardware. And China and emerging markets in general are set to benefit a lot from the government stimulus that has been provided. So just to explain that in a little bit more detail, a lot of countries, not just South Africa, will be using infrastructure in order to deal with some of the problems caused by the pandemic. So you would have heard, if I use South Africa as an example, you maybe would have heard that our president and the finance minister have been talking about infrastructure and these private-public partnerships and how infrastructure can really help to get us out of some of the problems caused by the pandemic. And how the investment in infrastructure can really assist is, if, for example, we had to build a new smart city or a new airport, the government would employ South Africans. So you employ some of your own people, you pick up some of the unemployed. So you're helping to make that unemployment rate, a little bit better. We know that a lot of people have been unemployed through this pandemic. So you employ your own people. Some of these will be contributing to the tax base. So in that way, the government also receives higher revenue because now you have more South Africans that are employed and can contribute to the tax base. And then at the same time, by, improving infrastructure, a country becomes more attractive as an investment destination. So why will emerging markets then benefit from this fiscal stimulus? Well, a lot of emerging markets are commodity producing nations, and in order to build new airports and new roads, you need raw materials. So commodity producing nations are benefiting from this fiscal stimulus. And as I said, it's not just South Africa that will deal with some of the problems with infrastructure. Infrastructure is a great idea, and a lot of countries are going to be using infrastructure in order to deal with the pandemic. So overall, firstly, the fiscal stimulus. Secondly, emerging markets, especially the Asian economies, have a rising middle class. We know that the middle class is the class of people that does consume. So they are able to keep money turning in the economies. They support the businesses by buying up their goods and services. So when you have a growing middle class, you can expect that middle class will support the growth in GDP as well. So there's a number of reasons why we feel very positive on emerging markets, and it does show even in the numbers of how they performed over the last year. So very positive on emerging markets overall, and you will see that there is an allocation to emerging markets in your portfolios. And then locally, we recently had the budget speech. So the budget speech was overall very positive. It was very much a pro-growth budget. We had some positive surprises, such as the 100 billion rand in extra revenue that was not expected. Corporate tax rate will be cut from next year, which is again very positive for business. And of course, personally, we never saw any increases in our personal income tax, which is very positive as well. On the electricity side, we know how important electricity is for growth. You need, the mines operating, the manufacturers being to operate, without any interruptions. So Eskom really is key to growth. And what the government has now done is they've relaxed some of their rules and regulations around, self-power generations and your renewable power, which is very positive as well. But I mean, Eskom and the load shedding continues to be a risk to the growth in South Africa. And then there's a bullet point on the slide that talks about the draft regulation 28 update, but I won't talk about it here. I've got a couple of slides at the end where we can unpack why they're making these changes and what these changes are proposed to be. And looking at the chart on the right-hand side, this is, the colors do look a little bit confusing, but this is really the debt trajectory. So the debt to GDP of South Africa. And you'll recall that last year, at the beginning of the year, Tito Mboweni spoke about an active and passive scenario with regards to managing the debt. And he said, debt is a massive problem in South Africa, and we need to actively manage this debt. And by actively managing, it means that we need to become really careful with the expenditure. So we really need to be careful, how much of the total, revenue we spend on, certain items. And we really need to get the public sector wage bill under control, which is also part of expenditure. And he then spoke about a passive scenario, saying if we don't act now and we continue to just, have this reckless spending and this public sector wage war getting out of control, that would be the passive scenario. In other words, sitting back and letting the debt just balloon. And the passive scenario would mean that the ballooning of debt would happen a lot sooner, and South Africa would, potentially fall off a fiscal cliff with very high debt to GDP ratio. Where we are currently is somewhere in between. Of course, the COVID-19 pandemic was not in the initial forecasts. And with COVID-19, South Africa has had to go and loan extra money. So taken, loans from the World Bank, etc. So we have increased our debt in order to deal with the pandemic, but then there have been the positive surprises such as, the extra revenue and a firm stance against expenditure from government. So the current trajectory, or the current line where it's projected to be, is the line that's got the 87.4 and the 88.9. So now we expect debt to peak at 88.9, and the previous the previous time that this was projected was at that line with 95.3%. So it's already looking better, although not as good as some of the bottom lines where we see, the active scenario had there been no COVID-19. So that's where we would have been. So this is just, a summary of, some of the thoughts around the budget speech, but again, overall, very much of pro-growth budgets and positively received by most financial analysts. So we do find ourselves in a low growth, low return kind of environment. And the reason for this low growth environment is because firstly, interest rates are low, which means that it leads to high asset valuations. We also have high debt, and I'm not talking about South Africa only, I'm talking about the world in general. So we are not the only ones that have taken on debt. We're not the only ones that have taken money from the World Bank. Governments have taken money from the IMF, from various institutions. And that chart that I showed you previously that showed us, the size of the stimulus of some of these economies relative to GDP, you can see that there has been some massive fiscal packages being provided, but unfortunately, this has happened via taking on more loans, which means higher debt. So high debt is not positive for growth. High debt, in fact, can stop a country from growing. When you have a lot of debt, when you receive tax revenue, instead of being able to spend this tax revenue on growth initiatives, unfortunately, you have to take all of the tax money that you collect and you pay down the debt that you have. So high debt is not good for growth, and it's one of the reasons why we do find ourselves in this low growth environment. In addition to that, the developed world has got aging demographics, and also there has been a structural shift in productivity. So there's a number of reasons why we're expecting lower real returns. And a country that we can look at as almost a roadmap that has been through this high debt, low growth kind of environment is Japan. So if we look at this graph and we see, well, what has happened to Japan since they've been in this low growth, high debt kind of environment, and the different lines represent different measures. So if we look at the white line is what their stock market has done over this more than 2 decades that they have been in this environment. And you can see that it's very volatile, goes up and down, and has grown only slightly if you look at the starting point and the ending point. So over more than 22 years that we're showing on this graph, you can see the volatility of the Japanese stock exchange over this period. Then the green line is the government bond yields, and you can see that those have been going lower and lower through time. And then GDP. So GDP is the measure of growth in the economy, and GDP is the yellow line. And you can see that the yellow line has pretty much gone nowhere over this whole period of over 2 decades. So high debt and low growth really isn't a good situation to be in, and this is the kind of roadmap that we can look at for some of the developed economies that may be experiencing this over the next couple of years. But as much as we're expecting lower returns, we still believe that being invested in equities is very beneficial for retirement fund members. So as much as the new projection of where we expect equity returns to land up over the future are lower than previously expected because of all of this debt and some of the problems that we see around the globe, we still do expect equity returns to be higher than bonds and cash. And for that reason, we still believe it is advisable to rather be in a 70 type of portfolio for the majority of your working life rather than to be in a conservative portfolio. So the way that the life stage models have been structured, we still believe is very much relevant to the current market environment. So in our view, what are some of the keys to success in such an environment? Well, we do believe that you should be invested in a high growth type of portfolio, as I said, for as long as possible. So work for as long as possible and be invested in more of an aggressive portfolio for as long as possible. We also believe that passive management really makes sense right now, and even if it is just an element of passive in your portfolios. So we saw in 2020 that passive funds really kept up with some of the best performers, and in fact through a lot of the months in 2020 our passive portfolios outperformed every other similar portfolio in the market. So passive, wonder performance debate, low fees. Looking ahead, we cannot predict what the returns of portfolios will be. We can only hope that they will be, good positive returns, but anything can happen in the markets. You might have a news event, this afternoon that could send the markets into the red territory tomorrow. So we cannot predict what returns will do, but what is in our control is the cost of the investments. And for that reason, it is important to have at least some elements of passive in your portfolio in order to bring the costs down. Because of course, with returns, your true experience and the true growth of your own personal investments in the fund is really the net of fee return. So fees do matter. And that's why we strongly believe that passive should appear at least as a portion of your retirement fund portfolio. And then tactical asset allocation is really important. So you know that we do practice tactical asset allocation in all of these SURF portfolios. So what we do is we sometimes make short-term changes depending on our outlook in the current environment. So if we had to be feeling positive on equities, we could, for example, go overweight equities, sell down some cash. So depending on our views on the various asset classes, we do make those tactical changes. And if you look at our track record with this tactical asset allocation, we really have added a lot of value to retirement fund portfolios. So it's important to continue to make those short-term changes in order to take to have a look at some of the opportunities and take advantage of some of the opportunities that have been provided in the market. And then lastly, we really believe that portfolios should have some sources of diversified strategies in there. So looking at various themes that we believe that will drive markets over the near future, and including some elements of those themes that you want in your portfolios. So a good example is the Fourth Industrial Revolution Fund. So you'll know that at Sygnia, we've always liked tech, and the Fourth Industrial Revolution Fund gives us exposure to some of the latest, technology innovations such as artificial intelligence, nanotechnology, robotics. So that is a theme that we believe will play out in the near future. All of those technologies will really become part of our day-to-day lives. And for that reason, we have included some exposure to the Fourth Industrial Revolution Fund in your portfolios. Healthcare is another theme that we believe in. So firstly, we find ourselves in a pandemic, and you have all of these big pharma companies working on vaccines, some of them for profit. In addition to that, you still have the world population aging. You still have all the other diseases and sicknesses that we had even pre the pandemic. And pharma companies have been very profitable. And with the aging demographics that we're seeing around the globe and people living longer and longer thanks to technological advancements and medicine, we do believe that the healthcare sector is set to benefit, and healthcare is another thing that we'd like to have exposure to, and therefore we have included those diversified sources of returns to your portfolios. So then let's look at how they have performed to the end of February. So just a reminder, the portfolios that I will be showing you in terms of returns will be the SURF portfolios, and the default strategy of SURF is to follow a life stage model. So it means that all members that have more than 6 years to retirement will be defaulted into the 70 portfolio, and as you get closer and closer to retirement, from 6 years before retirement to the year before you retire, we will automatically transition you into more and more conservative portfolios until 1 year before retirement you're sitting in the 40 portfolio. Now, those numbers in the portfolios, so 70 would imply that there's about 70% allocation to equities, whereas 40, the signature 40 or skeleton 40 portfolio, implies that there's only about 40% allocation to equities. So the 40 is less aggressive than the 70 because the 40 only has 40% in equities and the rest will be invested in safer type of asset classes like equity, like bonds, like cash. And then, of course, management committees do choose between the skeleton, signature, and synergy range. But within all of those ranges, there's a 70, 60, 50, and 40 portfolio. As you can see at the top, that's how the life stage model has been set up. From a risk and return perspective, as I mentioned, the 70 portfolios will have about 70% allocated to equities. That's why if you have to look at them on this risk return scatter plot, with the risk being on the horizontal axis, so the further right you look, the more risk a portfolio is taking on because it has more invested in risky asset classes such as equities. You'll see all the 70 portfolios are plotted there, whereas lower risk is further to the left, and those would be your 40 portfolios. Investment theory does tell us that the higher the risk, the higher the return. So investors are rewarded over the long term for taking on that risk. And that is why we want younger members to be invested in the 70 portfolios because they do have a long time horizon. They're able to take on some of the risk of investment markets. Investment markets go through cycles. Even if there is massive drawdowns, they do, eventually recover. So if you have a long time horizon, it's better to take on the higher risk and the higher return over that period. And where are the portfolios invested? So for each portfolio, we have the strategic model column and the tactical model column. So I mentioned to you a little bit earlier on, tactical asset allocation being really important in the current market environment. And on this chart or this table, you can see how we practice that tactical asset allocation. So you'll see that the strategic model is the way that the portfolios are designed to be over the long term, and I'll only focus on the 70 portfolio. And the tactical model is where we currently invested. And you can see that the numbers are not the same, meaning that we have made some tactical changes in response to what we believe is beneficial in terms of investments right now in the current market environment. So for example, in the signature 70 portfolio, we should have about 48% invested in equities over the long term. That's the way the portfolio has been designed, but we are slightly underweight, so we've only got 47. We overweight the bonds, underweight the income in the money market. The global equity, you'll see that over the long term, the portfolio has been designed to have only about 22% in global equity. We're currently sitting with almost 27%. We've been investing in global equities due to just the amount of diversification that these global portfolios can provide, and global markets have been doing well and adding really positively to your portfolios. But in the bond space, supposed to be 4% over the long term, but at the moment it is 0. And if you think back to that slide where I spoke about the US and the concerns around inflation and the fact that they said they'll keep their interest rates low right through to 2023. Well, when you invest in bonds, the coupons that you receive regularly are linked to the prevailing interest rates typically. And if that interest rate is 0, then it's not a very attractive investment. And that's why we haven't invested in global bonds. Having said that, we have seen that, US yields are rising. So we may at some stage, start increasing that exposure, but at the moment it's 0. And you'll see global cash sitting at, almost 5%. The reason for that is that last year we had an even higher allocation to global equities, and we did take some profits. And we took some profits specifically from your exposure to the Oxford Sciences Innovation Fund. So we took those profits and we used the opportunity to then convert those profits into US dollars when the rand was at 14.50 to the dollar. So it was good move at the time, and that's why the cash holding is sitting quite high on the global side, again providing some diversification to the rand. And how do we then implement these decisions? So once we know what the asset allocation should be, so we know 47% in equities and 14% in bonds, etc. In the signature portfolios, we then implement by way of using both active management and passive management. So you'll see in the equity building block, you've got the Sygnia Swix tracker. So that's a passive strategy. That's where Sygnia manages this portion by simply replicating the Swix, so it's completely passive. There's no active decisions of whether you like Naspers more than you like BHP Billiton. You're simply replicating the index, and that's why it is passive. But then we combine that with some active managers. So you've got ABAX, 91, and Coronation, and these are active managers that do a lot of research on the stocks, and they decide which stocks they want to buy and which ones they don't want to buy. And in the bond space, we've got Coronation and the Sygnia passive bond, again, a blend between active and passive management. On the money market side, it's just 91 and Quanta that are managing the money market instruments. And on the global equity side, it's all passive. What I want to highlight on the global equity side is that as much as the regulations do allow that 50% offshore, I just want to highlight that we're not just simply, just taking the money offshore into any index. You'll see the amount of line items that are there showing that there really is a lot of consideration into the kind of themes that we want exposure to in these portfolios. And if you see, that's where you'll see the health innovation funds. So I spoke about health as being a big theme for the future. You'll see small allocations to the fourth industrial revolution funds. There's various regional exposures. There's exposure to the S&P 500, which is a stock market index in the US measuring the performance of the 500 largest stocks. So that also gives us a lot of exposure to tech. So a lot of research and care has been taken to construct these portfolios, and they have performed really, really well, which we'll see in the next couple of slides. The passive version of these portfolios, exactly the same asset allocation. So where we looked at that 47% in equities and the 14% in bonds, in the skeleton range, we follow exactly the same asset allocation, but we just don't make use of any of the active managers. So it's purely passive strategies, and in this way we are able to keep the costs in this portfolio really, really low. So you'll see in the equity space, instead of having the Swix tracker together with your Coronation, your 91 active managers, here we purely have the Swix tracker. Same as in the bond space, we just have the Sygnia passive bond fund, which passively tracks the all bond index. On the global equity side, all of the portfolios are exactly the same. So the skeleton 70, the synergy 70, and the signature 70 would have exactly the same offshore component, which is the nice mix of assets that I showed you on the previous slide. It's exactly the same on this side as well. So now that you've had a look at, kind of where your portfolio is invested, how much is in equities, how much is in bonds, how much is offshore, let's then have a look at how the markets have performed and how your portfolios have performed. So as much as 2020 was one hell of a year, it started off very rocky with tensions between the US and Iran, and we very quickly became aware of this virus in China. Already in the first quarter, it had spread all around the globe, and we found ourselves in a lockdown, and most of the world went under some sort of lockdown. Following that, South Africa got, downgraded to junk status. We've had, the US elections that caused a lot of volatility. Brexit was ongoing throughout the year. So a lot of, key events were happening in the globe. But despite that, if you looked at the performance from 1 March 2020 to the end of Feb 2021, if we focus on the 1 year numbers, we can see that the South African market actually did very well. Looking at the Swix index, which is the index that we track in your portfolios, we can see a return of 26.1% over the year. You could also argue that it's also coming off a low base because we did start seeing the volatility in the markets around Feb, March last year. So coming from that low point and some of the nice growth that we've seen, especially in the fourth quarter of last year and the beginning of this year, we've seen that markets have been running quite hard on the back of the fact that there is a vaccine and we do have a strong president in the United States. So markets have been doing quite nicely. Property still struggling, and then global assets still providing you with positive returns. So having a look at your portfolios, we can see that the Signature, Skeleton, and Synergy range of portfolios all gave us, 21% returns over the 1 year. So some, a few basis points more than the others, but all really great double-digit returns over the 1 year and way ahead of their benchmark at 19.9%. You can see that the more conservative portfolios, so the ones with less equity, so the 60 funds have, 10% less equities, the 50 funds have only about 50% in equities, and then the 14 funds about 40% in equities. You can see that over the 1 year, those returns are slightly lower because of the smaller equity allocation. And then if we had to look at the Signature 70 fund and how the performance of the overall portfolio compares to the underlying managers, you can see that the performance has been quite different to some of the single managers that are available for member investment choice and that are in some of the Signature portfolios as well. So Alan Gray, being a value manager, struggled a bit, but still nice double-digit return, almost 17%. Coronation has by far been the best performing manager, so this manager is also included within the Signature portfolio. Ford, also really good performance at 19.2 and 91 at 19.3. 91 is Investec Asset Management. They changed their name to 91. And then the Islamic Balance portfolio, for those members that want to invest in a portfolio that follows Sharia compliant laws, that gave us 16.1%. So you can see overall all managers giving you nice positive double-digit returns, but there is some differential between the performance of each of these, and we never expect all asset managers to perform in a very similar fashion across the market cycles. So looking at these, 21% returns over the 1 year, well, where did the performance come from? Firstly, we avoided property. So property has struggled. If you looked at this table 2 months ago, property was actually sitting at minus 35% for the 1 year. So it has recovered a bit. You'll see that the February number is positive. You'll see that the 3 month and the year-to-date number is positive, but still over the 1 year, if you were investing in property, it is returning negative. So that minus almost 16% really would have hurt the portfolios. So we don't have any direct exposure to property in the portfolio. So by being able to avoid this negative returning asset class, we have managed to perform quite well. Then I highlighted that the SWIX has actually done well. So the South African market, again, you could argue that it has come off a low base, but it has done well over the 1 year, returning 26.1%. And of course, some of the active managers that you have in your Synergy portfolios and your Signature portfolios, depending on their calls between resources, industrials, and financials, you can see that the performance was quite different. So the asset managers that had a large exposure to resources would have done very, very well. Resources gave us 66.4% over the 1 year, where financials, on the other hand, gave us -6. So depending on the calls of the asset managers, that also made a difference. And then last but not least, we do invest about 30% of these portfolios outside of South Africa, and global assets have done really, really well. I mentioned earlier that we're feeling very positive on emerging markets, and that emerging markets actually have already performed well. You can see that in this, where I have highlighted those numbers. The first number, the 24.3%, is the return of the MSCI World Index, which measures the performance of global developed market stocks. The second line is emerging markets. So this is where China, a lot of the Asian economies, South Africa, Brazil, All of our returns are in the emerging markets, but China being the biggest weighting, so very much driven by China. You can see they did 30.7% over the 1 year. And in the mix between those two, with a higher weighting to developed market, is the All Country World Index, which looks at developed and emerging markets, and we can see that that gave us 25.1%. So this is really where the performance came from, the fact that we avoided property, the fact that we did have skillful asset managers in your Signature and Synergy portfolios, and of course the offshore allocation has really helped returns as well. So looking at the performance over the long term, you'll see that all three of these portfolios comfortably outperformed the black line, and the black line is the median performance of the managers listed at the bottom. So the managers listed at the bottom, Alan Gray, Coronation, 91, these are all very large, very experienced asset managers in South Africa. They have experienced teams, they've been managing money for a very long time, and for that reason, it's very well accepted in the industry that if you can outperform the median, which is that black line, that your portfolio has done very, very well. And then lastly, just to look at the surveys. So these surveys are prepared independently by Alexander Forbes Investments, and what they do is they compare like-for-like portfolios. So you wouldn't want to compare a 40 portfolio with a 70 portfolio, because the one would have about 40% in equities, the other about 70, and it's not really a fair comparison. So the way they group them is they compare low equity portfolios with low equity portfolios, medium with medium, and high with high. So on the slide at the moment is the low equity multi-manager survey. And we can see that over the 1 year, the Signature 40 fund has been the best performing, followed very closely by the Skeleton 40. So there's only a 0.3% difference. Over the 3 years, it was the Signature 40 again. And over the 5 years, you can see that the Skeleton 40 is only 0.2% behind Old Mutual and Alexander Forbes Conservative. So very, very close in performance. And then over the long term, the Signature 40 has been the best performing in the low equity multi-manager survey. If we look at the 50 fund, so this is the one with about 50% allocation to equities compared to similar portfolios, you can see that over the 1 year, it is behind the Old Mutual inflation 3+5, but over the 3 years, the Signature 50 fund has been the best performing. Over the 5 years, only 0.2% behind the best performing portfolio, and importantly, over the 7 and 10 years, the Signature 50 fund has been the best performing, followed closely behind by the Skeleton fund over 10 years. The 60 fund, Signature has been the best performing. Closely behind that is the Skeleton portfolios, and that's across all periods. And then the most important ones are the 70 portfolios. Why I say the most important ones is most members will spend the most of their working lives investing in these portfolios. Members are likely to be in the other portfolios for a shorter period of times. Of course, there will be the odd member that makes an active investment choice that they want to be in one of the other portfolios for, their working career, but most members do default and they do follow the life stage model, and they do stay invested in the 70 portfolios for the majority of their working lives. So this really is the portfolios to focus on, and we can see that over the 1 year, all very close in performance, and all three of our portfolios are way ahead than all the others in the industry. So the best performing portfolios over 1 and 3 years, and over the 5 years, you can see that Synergy is at the top of the ranking tables, and Signature and Skeleton are 1% or so behind. But importantly, over the 7 and 10 years, and why I say importantly over the long term is, as I said, these are long time horizon portfolios. They're not portfolios where you want to be in and out, every other month. These are the kind of portfolios that you stay invested in for the long term. So it's important to look at the long-term performance to see that consistency of performance. And we can see that the Signature 70 fund has been the best performing over 10 years. This return of 12.3% is what we call an annualized return. So had you been invested in these portfolios for the last 10 years, your return would have been 12.3% per year for the last 10 years. And then lastly, just to compare these to the single managers, we can see that over the 1 year, as I mentioned, Coronation has done phenomenally well. So they have been the best performing single managers, but our portfolios are, you know, right behind that, with most of the single managers actually underperforming our portfolios as well. Then you can see over 3 and 5 years, and importantly, over 10 years. Again, the Signature 70 fund has actually managed to outperform every single manager in the survey as well. And bearing in mind that some of these single managers are also quite a bit more expensive, on a net of fee basis, differential might even look quite a bit larger. And then looking at it from a risk and return perspective, because return is the one element, but at the same time, you wouldn't want your portfolio or your asset managers that are managing your portfolios to take on excessive risk. You do want to have a good risk return ratio in these portfolios as well. So looking at risk again on the horizontal axis, the further right you look, the more aggressive a portfolio is. And when I say aggressive, it means it's taken on more risk because it has more equities, more property, more alternative investments, more hedge funds. All of those type of asset classes increase risk, and in having a lot of cash, a lot of bonds reduces risk. So the portfolios that have more of those asset classes will be further to the left. So if you look at the Signature range, for example, you'll see that the 40 fund takes on less risk than the 70 fund, and that the return is depicted on the vertical axis. So if we look at the 70 portfolios, the ones that I like to focus on, where members will be spending the majority of their working lives, you can see where the 70 portfolios are somewhere there between 9 and 10% of risk. So the Signature and Skeleton have a little bit less risk than the Synergy Fund. And for that level of risk, they have been the best performing portfolios. So the way to interpret this is for every level of risk, you actually want the top performing portfolios. And the portfolios to the right that are a little bit more extreme are the Momentum portfolios and the Sanlam MM70. We can see that they have taken on even more risk by taking on, 10, 11%, even more of risk, but they simply haven't been rewarded for that risk taken if you look at their corresponding return on the vertical axis. And then lastly, I want to talk a little bit about these proposed changes to Regulation 28. Now, last year and even prior to that, there was a lot of panic in the market. There was some media articles that were talking about prescribed assets and how the government wants to take our money and support SOEs. And now that they have released the draft of, the proposed changes to Regulation 28, it's not that at all. There's no prescription, which we already knew. Government did, tell us or communicated last year that some of the changes that they propose making is only around road infrastructure, and there won't be any, prescription as it stands now. So prescription really is when you get forced to buy into a certain asset. So prescription would be if a piece of legislation came out to say every retirement fund has to invest 10% in infrastructure, or every retirement fund has to invest 10% to support government bonds, or whatever the case may be. If they say that you have to, that is prescription. The way that Regulation 28 is set up now is you have certain limits that you cannot exceed, but you are by no means forced to invest a certain percentage in any, certain share. For example, we are allowed to invest 30% offshore with an additional 10% into Africa, but I haven't seen a retirement fund portfolio that has utilized the full 10% investment into Africa, for example. So the limit is there. You can't go above 10%, but if you don't want to invest into Africa at all, you don't have to. So we've seen the draft. The draft was published on the 26th of February, and they will be accepting comments on this draft right up until the 29th of March, which is in a couple of days' time. And what they're proposing is they want to make it easier for retirement funds to invest in infrastructure. And as it stands now, infrastructure is not defined in the regulations. And in addition to that, there's been more and more interest in private equity. So these are, companies that are not yet, listed on stock exchanges, so a little bit further away from, being listed. So they're non-listed typically in private equity, and they are smaller companies that have more of a growth expectations. So private equity in general, as I said, has received a lot of attention, especially in a low return kind of environment. And as it stands now, hedge fund, private equity, and other assets have one kind of asset class together in Regulation 28. So this new draft aims to clarify these matters, to define hedge funds properly, to give all of these asset classes its own limit. Currently, they're kind of lumped together, saying you can invest in hedge funds and private equity and alternatives to X limit. So what does this draft say? So I just firstly want to make clear that it is at the moment a draft. As I mentioned in the previous slide, they are receiving comments right up until the end of the month. They'll probably consider all of those comments, and then on the back of that, they will issue the final regulation. But as it stands now, they're proposing to define infrastructure. So as I said, at the moment, it's not defined. And to also clarify that investments into infrastructure can be done via various asset classes. So it doesn't have to be just bonds, it doesn't have to be just equity, it could also be private equity type of investments. So the investments in infrastructure will be recognized within the various asset classes, and they propose that the limit on infrastructure, so again, this is not prescription where you have to invest a certain percentage into infrastructure. It's a limit whereby a retirement fund will not be able to exceed that limit, and that upper limit is 45%. So it means that looking through across all the asset classes, so you could invest in infrastructure, in certain projects, they may be issuing bonds, other projects you may be able to get in via private equity, other projects, infrastructure projects, you might be able to get in via just normal equities. And looking across all of those asset classes, infrastructure shouldn't have a limit of more than 45%. So that's what they're proposing. They proposing to allow an additional 10% in respect of Africa, just like they do with offshore investments, and then to limit the aggregate exposure to issuer or entity to 25%. So not to say, okay, we allow 45% and you're going to use that whole 45% to support one project or issuer. The maximum will be 25% per issuer. So that's what they're proposing in terms of infrastructure. And then, as I mentioned, hedge funds and all these other asset classes were not necessarily clearly defined, so they proposed to define hedge funds. So hedge funds, private equity, and other assets, they currently have a single limit of 15%, whereas they're saying that private equity should have its own limits. So after delinking the asset classes, the limit for private equity, as I said, there has been quite a bit of interest, is proposed to be increased to 15%, and it will be an asset class on its own. It won't be lumped together with the other one. And hedge funds and other assets will remain unchanged at 10%, so 10% for hedge funds, and then other assets, which could be some of your alternatives, would be at 2.5%. And the overall collective limit is being removed, whereas they used to view this hedge funds, private equity, and other assets, they also had this collective limit of 15% before. So that collective limit is reduced now, so you could have 10% in hedge funds, you could have a full 15% into private equity. So these are the current proposed changes to Regulation 28. And although I've said it before, I do want to say it again, this is by no means prescription. So all the panic that we saw in the various news articles that we saw previously in the media, they didn't materialize. And this is simply, really just defining infrastructure. And if you think back to what I said about, how you can help economies grow through the current environment that we're living in, infrastructure really is positive. With infrastructure, we can improve the unemployment rate, and with infrastructure we can also increase the tax revenue. So overall, very positive. We at Sygnia feel very positively about infrastructure as a whole. We've been doing a whole lot of research in the background, looking at the various infrastructure opportunities, and you may very well see that in the very near future you'll have some infrastructure, proper infrastructure allocations in your retirement fund portfolios when we look at the lineup of the various asset classes. So that's all I have for you this morning. I'm happy to take some questions. We are almost out of time, so there's only 5 minutes left. I don't see any questions at the moment in the Q&A. So what I would suggest is that you pop us an email if there's anything that you want a little bit of further clarity on. And of course, the recording of this presentation will also be circulated to everyone that has attended. So again, I want to thank you very much for listening to me for the last hour on this Thursday morning, and please do join us again for our monthly webinar next month, where Denisha will be presenting the report back to us. Thank you very much.